Most people view all debt as the same thing. Something to fear, avoid, or pay off as fast as possible. But not all debt is equal. Some debt quietly destroys your finances. Other types of debt, used carefully, can help you build a stable future. The difference between good debt and bad debt is not in the word debt itself. It is in what the borrowed money actually does for your life. At its core, the difference is simple. Good debt is money you borrow to acquire something that has a real chance of producing long-term value or income. Bad debt is money you borrow to consume something that will lose value quickly or generate no return. The label depends not on the lender or the loan paperwork. It depends on what happens after you spend the borrowed money. This matters because confusing the two can shape your entire financial life. People sometimes avoid all debt and miss opportunities to build long-term value. Other people embrace all debt and quietly destroy their stability. Understanding which type of debt is in front of you, before signing, is one of the most important financial skills you can develop. The same dollar borrowed can build or break depending on its purpose. To understand how it really works, think of two questions before any loan. First, will the thing you are buying have any lasting value or income potential? Second, is the cost of borrowing, the interest, low enough that the value you gain outweighs what you pay? If yes to both, the debt may lean good. If no to either, the debt usually leans bad. The answers shape your future cash flow. Let us look at a simple example. A mortgage on a reasonably priced home you can comfortably afford can lean toward good debt. The property may hold value, you build equity over time, and the interest rate is usually moderate. A high-interest loan to buy a luxury item, on the other hand, is almost always bad debt. The item drops in value, the interest is high, and nothing lasting is built. A common mistake is to think of good debt as automatically safe. A mortgage is not always good debt. If it is too large for your income, if it traps you in a property you cannot afford to maintain, or if it forces you to skip savings entirely, it becomes a quiet liability. Good debt is good only when its size and terms match your real ability to manage it over time. There is also a hidden risk in bad debt that many people underestimate. High-interest debt for consumption can compound rapidly. A few $1,000s on a credit card can become much more over the years if only the minimum is paid. Beyond the math, bad debt also restricts your future choices. You may end up working jobs you dislike just to keep up with payments on things you no longer use or enjoy. A useful way to picture this is as two different uses of fire. Fire can warm a house or burn it down. The same fire, used carefully, is a tool. Used carelessly, it is destruction. Debt is similar. Used carefully, it can be a tool for buying productive assets, financing essential needs, or improving long-term outcomes. Used carelessly, it can quietly burn down years of financial progress. A second key idea is the role of interest rate and time. A low-interest, long-term loan on a productive asset behaves very differently from a high-interest, short-term loan on a depreciating item. The same idea, borrowed money, can have completely opposite effects depending on these two numbers. Beginners often focus only on the monthly payment. Wiser borrowers focus on the rate, the term, and the purpose together. A practical example helps. Imagine someone borrowing for education that meaningfully increases their long-term income at a reasonable rate. That borrowed money can pay itself back many times over through better career options. Now imagine someone borrowing the same amount to fund a luxury trip with high interest. The first loan may build value for decades. The second can quietly damage finances for years after the trip is forgotten. Beginners often misunderstand the role of consumer credit. Credit cards themselves are neither good nor bad. The label depends entirely on how they are used. Paid in full each month, they offer convenience, security, and small rewards. Carried as a balance month after month, they become one of the most expensive forms of borrowing in existence. The same product, two different outcomes, driven by behavior. There is also a psychology angle. Bad debt often grows in moments of emotion, stress shopping, social comparison, impatience for things you cannot yet afford. Good debt usually grows in moments of planning, when you sit with paper, calculate, and decide carefully. Most people do not end up in bad debt because they wanted to. They end up there because they made financial decisions while feeling something rather than thinking something. A simple practical rule helps separate the two in real life. Before any loan or credit purchase, ask yourself if the thing you are buying will still hold value, produce income, or improve your life 5 years from now. Ask if you would happily pay that interest in slow motion across many months. If the answer is no, the debt is leaning toward the bad side. Treat it with extra caution. There are things to avoid. Do not finance everyday items with high-interest credit unless absolutely necessary. Do not stretch a good loan beyond a size you can actually carry through hard times. Do not let lenders or marketing convince you that more credit is a sign of success. Do not borrow to maintain a lifestyle that does not match your actual income. And do not ignore the cumulative effect of many small loans. A better habit is to think of every debt as a future obligation that will affect tomorrow's version of you. If your future self would thank you for the loan, it is likely good debt. If your future self would resent it, it is likely bad debt. The simple act of mentally consulting your future self before signing any paperwork can prevent a surprisingly large number of regrets later in life. Over the long term, the careful use of debt becomes one of the most powerful tools in personal finance. Good debt, taken in reasonable amounts at fair rates, can help you build property, education, or a business. Bad debt, accumulated carelessly, can quietly steal years of financial freedom. The same financial tool produces opposite life outcomes depending entirely on the discipline and clarity of the person using it. So here is the short version. Good debt funds things that have lasting value or income potential, at reasonable rates and sustainable amounts. Bad debt funds consumption or quickly depreciating items, often at high rates. The label depends on purpose, cost, and your ability to manage the loan. Both can exist in the same life. The key is knowing which one is in front of you before you sign anything. If you want to build a financially strong life, treat debt with neither fear nor blind enthusiasm. Some debt will help you. Some will hurt you. Always ask what the borrowed money is actually doing. Match the loan to a clear long-term purpose, a fair rate, and a comfortable repayment plan. Used carefully, debt becomes a quiet partner in building wealth. Used carelessly, it quietly becomes the master of your life instead.